Hello and welcome to a Federalist Society panel on corporate social responsibility. My name is Todd Henderson. I teach at the University of Chicago Law School, and I have the great pleasure of being joined by two great thinkers generally, but also specifically on this topic, and friends of mine. First, joining us is Stephen Bainbridge from the Hollywood Hills. Steve is the William D. Warren Professor at the UCLA Law School. He is a prolific and brilliant mind. Some of my colleagues were doing a curricular innovation here, teaching first-year law students business, what it's like to be a transactional lawyer, and they said, where should I go to have some readings for the first principles of corporate law and business formations? And of course, I pulled off my shelf Steve's Corporation Law and Economics, which is the go-to horn book in this field. Steve and I also are co-authors. We've written two books. I'll plug those: Outsourcing the Board and Limited Liability, a legal and economic analysis. He's a dear friend, a great guy. I'm delighted to have him. Elizabeth Pullman is a professor of law at the University of Pennsylvania. She is a co-director of their Institute for Law and Economics. And although it's a cliche, it's appropriate. She is a rising star, a voice that we will hear a lot of in the future. And I'm really looking forward to her remarks as well. She's a future co-author of mine, although she doesn't know it yet, on a project to be determined. Okay, here's the way this is going to work. We have 90 minutes. We're going to hear from the panelists, frame this conversation, but this will be much more interesting for everyone if we hear from you. So ask your questions. This is a smart and informed audience. These experts are here to talk about what you want to talk about. If you want to do that, use the little raise hand function in Zoom. If there are somebody on the telephone, I guess that's a possibility. You can dial *9, I'm told. We'll see if we can make that work. So please engage early and often. And then I'm just supposed to remind everybody the next event is a Young Scholars paper presentation that starts at 3 p.m. Eastern. Okay, the topic of the day is corporate social responsibility. Obviously, this has been a big topic since forever. Milton Friedman really laid down the gauntlet on the shareholder wealth maximization with his paper or his piece in the New York Times Magazine in 1970, saying the corporate social responsibility or the responsibility of corporations is to maximize profits. They should leave politics and social welfare up to a government. So just follow the rules and make a bunch of money, and everything flows from that. That battle has been joined and fought in various forms. Ralph Nader in the 1970s, Lucian Bebchuk and others today. It happens inside of companies as they're trying to decide what to do in boardrooms. It's now increasingly happening in legislatures around the country, in California with diversity requirements, and Illinois. Liz Warren has a, what she call it, the Accountability Capitalism Act, which I went to bed a couple nights ago thinking has no chance of ever becoming law, and then woke up and realized the Democrats had gotten control of the Senate and thought now, well, maybe there is something there. Maybe there is going to be federal corporate law arising out of this in some form or other. So a topic of great interest in a lot of dimensions. And with that, I will turn it over to Steve for his opening remarks. Steve, take it away.
Thanks, Todd. And it's a pleasure to be with my good friend Todd and my good friend Elizabeth today to talk about this issue. And as Todd teed up, the debate between the sort of Milton Friedman school of shareholder wealth maximization being the appropriate decision-making norm that corporate fiduciaries ought to follow, in contrast with the idea of corporate social responsibility, as it's long been known. Increasingly, we talk about ESG, sustainability, and so on. And these CSR, ESG, do have increasingly strong support from interest groups ranging from Occupy Wall Street to Elizabeth Warren to Larry Fink and so on. And I just want to tee it up a little bit by talking first about the basic reason why I think shareholder wealth maximization is the superior norm. And then also talk a little bit about why it is that business these days seems to be moving in the CSR direction. I think it's the basic argument for shareholder wealth maximization is that it gives clear answers to otherwise difficult questions. Suppose, for example, that the board of directors is considering closing an obsolete plant. The closing will harm the plant's workers and the local communities, but conversely, it will benefit the shareholders, it'll benefit the creditors, excuse me, the employees at a more modern plant to which the work was previously performed gets transferred, communities around the more modern plant. And we assume that the latter groups cannot gain except at the former group's expense. And so we ask, well, what standard should the board use in making that decision? And shareholder wealth maximization provides a clear answer, namely close the plant. Once directors are allowed or even required to deviate from shareholder wealth maximization, they must inevitably turn to indeterminate standards that require them to balance the interests of multiple parties. Standards that require the directors to balance the interests of multiple constituencies, trading them off from case to case, deprive directors of the critical ability to determine ex ante whether their behavior comports with what the law requires, and raises the transaction costs of corporate governance. The conflict of interest rules that govern us lawyers provide a useful analogy. Despite many years of refinement, those rules are still widely regarded as inadequate, vague, and inconsistent, which is hardly the stuff of which certainty and predictability are made. And as we all know, certainty and predictability are the transactional lawyer's best friends. Absent clear standards, moreover, directors will be tempted to pursue their own self-interest. Directors who are responsible to everyone are accountable to no one. In my hypothetical about the plant closing, if directors are allowed to consider social responsibility, they may, in their heart of hearts think, well, what do our interests favor? And if the board's interests favor keeping the current plant open, then we could expect them to say something like, well, we're going to keep the current plant open even though it's inefficient because we're worried about the effect of the workers in the local community. In contrast, if the board's interests are served by closing the plant, they'll close it. And they'll talk about concern for the firm's shareholders, creditors, and the new constituencies in the new location from the new plant that will benefit. In other words, corporate social responsibility is easily transformed into essentially camouflage for self-interested directors making decisions that benefit mainly themselves. Now, the business community used to acknowledge that their obligations ultimately ran solely to shareholders. But in recent years, we've seen the rise of woke capitalism. And most notably, of course, was the Business Roundtable's 2019 Statement on Corporate Purpose. The Business Roundtable historically had taken the position of shareholder wealth maximization. But the 2009 statement proposed embracing woke capitalism. So what are we to make of that statement a year and a half later? What have we seen? Well, Some of the folks who signed that statement are themselves social justice warriors. We have seen the rise of sort of the social activist CEO. And I'm thinking here in particular of Salesforce.com CEO Mark Benioff, who constantly is promoting social activism. And yet, interestingly enough, when time came that Salesforce ran into some financial issues, they slashed 5,000 employees. And so, one wonders just how serious the commitment is when push comes to shove. Some contend that Business Roundtable's leaders were responding to perceived customer and labor demands. In particular, we are told that millennials prefer to work for and purchase from companies that are perceived as socially and environmentally responsible. And there's a widely held view in the business community these days that to attract millennial and Generation Z workers and customers, companies must project an image as social justice activists. And we see this, for example, with Nike's embrace of Colin Kaepernick as being a fairly obvious example of this phenomenon. But what's been interesting to me is that even red state companies like Walmart have been embracing in various ways socially progressive stances, despite the risk of alienating their red state customer base. There's no doubt that a few powerful investors, particularly the big three ETF companies, Vanguard, BlackRock, and State Street, have embraced woke capitalism. They have specifically embraced social activism in support of progressive goals with respect to the funds they manage. BlackRock, for example, encourages companies to pursue excellence in ESG metrics as well as in terms of stock return. BlackRock CEO Lawrence Fink famously sent a letter in 2018 to the CEOs of their portfolio companies, urging them to be more responsive to stakeholders and to pursue ESG goals to achieve sustainable growth. Finally, the move by business may well have been an attempt, anticipating what ultimately came to pass. It may have been an attempt to head off regulation by progressive politicians. Back during the 2020 primaries, David Benoit of the Wall Street Journal observed that Elizabeth Warren has made the case that the primacy of shareholder returns has worsened economic inequality and enriched investors at the expense of workers. With the mainstream of the Democratic Party seemingly moving in Warren's direction on these issues, the Business Roundtable's members may have hoped that a voluntary and perhaps intentionally ambiguous embrace of corporate social responsibility, at least as platitudes, would help them fend off more intrusive regulation in the event of a Democratic victory in 2020. If so, maybe they were hedging their bets wisely, since they now have to deal with Democrats running both ends of Pennsylvania Avenue. The bottom line, then, I think, is that somewhere Milton Friedman is spinning in his grave. The trend lines are all running, for the moment at least, in the direction of increased social, political, and legal pressure for companies to adopt corporate social responsibility as their metric. And as I suggested at the outset, I think that's going to result in significant decline in the quality of corporate governance. Thank you. Looking forward to the discussion.
That was fabulous framing, and just to recapitulate that, I think I heard three theories that I think are noteworthy just to call out from what Steve said. The first one is the possibility that this whole movement, let's just call it that, this focus that has caused us to start to have this panel is a real phenomenon. That is that in the markets that companies compete in for products, for labor, and for capital, those people are increasingly demanding that companies, commit to or actually act good. So that's one possibility. This is a cultural phenomenon. You mentioned millennials. Something has changed, and we want corporations to be actors for the social welfare and public good beyond just their profit-making Adam Smithian purpose. The second thing I heard, which I think is, on the other side of the ledger, which is this is just self-interested directors who are pushing this to protect themselves. After all, if you're running a bad company, that is, it's not making money, you can always say, oh, yeah, but we're doing a really good job in protecting the whales, protecting workers, climate change, whatever it is. So this is just window dressing that protects bad managers and reduces the potential discipline from people like activist shareholders. That's a second possibility. And then the third one, which is, kind of in the middle, I guess, or going in both directions, which is this is a preemptive strike telling government, we are cleaning up our own house. You don't need to pass this Accountable Capitalism Act. We are committing ourselves to act this way. And, that could be good or bad. It could be that they actually are, and, they want to forestall regulation by disciplining themselves, or it could be completely bogus, which is just, we're going to talk a good game, you won't regulate us, and then we'll just keep on doing what we're doing. So I think that's a really great framing. I think those all sound interesting and plausible to me. And now let's hear from Elizabeth, who will offer her perspectives on those things or something else.
Thanks very much. It's always just a great fun talking with you, both Todd and Steve. I always welcome that, and especially on a conversation about something like corporate social responsibility. So I thought I would say just a little bit about 3 points in my remarks about the time we're in, the system we're in, and the future that we might see. So the time we're in, I think that change is afoot. I think there is generational change. And I think there's change in terms of politics or ideology and academic thought and agendas and more. I think the law and economics movement that so influenced the 80s and 90s is not going to be the dominant school of thought in the 2020s and beyond in the same way that it was framed in the past. And when I was a law student, which was almost 20 years ago, when I think back to an experience I had in a seminar on advanced corporate law. And the format was we would read current works in progress or important papers by leading scholars, and then we would write critiques. In one of my student response papers, I pursued a line of argument that shareholders weren't homogenous, that they cared about different things in corporations. And my professor, who I still very much respect, told me at the time, no one takes that argument seriously, Elizabeth. And around that time, Professor Bainbridge's late colleague Lynn Stout was actually pursuing a similar line of research. And now with many other scholars, that inquiry has really flourished. And variations and expansions have also emerged in the literature alongside market developments like the rise of large mutual funds, such as arguments that large institutional investors own the market. They have an interest in countering the climate crisis. Some of the foundational ideas or arguments underpinning shareholder primacy, the nexus of contracts, shareholders as the residual claimants, that shareholder wealth maximization might be a clear answer. Those ideas are coming under pressure from mainstream and distinguished academics, and they're not reflexively accepted. Although I'm not saying that they aren't important ideas that will be carried forward in some ways, they're under pressure. And outside the academic world and discourse, many trends seem to be coming to a crux that are influencing the environment in which corporations are acting. And some of those trends are things like economic inequality and wage stagnation. To put it simply, we've just had many years of workers and everyday people not doing very well, not getting ahead. We've been in a period for the past 20 years or so where we seem to veer from crisis to crisis, the dot-com bust, the global financial crisis, now the pandemic, racial equality movements, climate emergency. And as Professor Bainbridge has discussed in his work, the rise of populism in the US and around the world, there's a lot of important trends that have been happening and culminating. And younger generations are questioning capitalism. And when you think about it, they have grown up in a time when we really are going from crisis to crisis. And there's these student loans, the employment market, when it even is employment and not gig work or getting on-demand scheduling, the lack of action on climate, the difficulty they face in getting to things like home ownership or participating in the stock market, you can start to understand why some views are shifting. The political moment that we've been in, which I usually don't, I really actually as a scholar, I don't tweet about politics. I don't do those types of political things generally in my work, although I study these things. But I can really see that there's shifts and important kind of turning points that we've arrived at. And even business executives and leaders, they were not in the vanguard. They're responding to what is already shifting underneath them. With events recently, we've seen, business leaders, I've seen recently venture capitalists say they don't want to do business anymore with certain types of movements and ideas and people associated with them. So we've been at a really a time in which these things are coming to a boil. And I think with a changing administration too, we're likely to see some movement on things that have been long discussed, like corporate political spending disclosure, perhaps ESG disclosures, but that's the time we're in. And that's a different time than when some of these original ideas that have been dominant for some decades now were culminated and created. And so then as to the system that we're in though, we have been in a period of now 4 decades or more in which some of those original ideas from the law and economics movement have been playing out and influencing the system that we're in that's broader than just law. And in a paper that I'm working on with Professor Dorothy Lund at USC called The Corporate Governance Machine, we're exploring that, about how shareholder primacy and orientation has really affected law, markets, and culture in a really significant way, such that law, not just Delaware corporate law, but the SEC, the Department of Labor, Congress, and markets, that's not just the institutional investors, but certainly they're an important part, but also the stock exchanges, the indices, the industry associations, et cetera, and culture, professional education and politics, and the media. These have all been oriented towards an understanding of corporate governance for shareholders. And that is really significant. That is has a momentum of its own, and that's the system that we're in. So I think for the future, I think there's more will, given my first point about the time we're in, there is more will to address the power dynamics and an interest in sustainability and social well-being and equity within corporate governance itself. More will than in a way we've seen in years past. There's more will for trying to restore a balance that takes into account the different trends that we've seen in markets and politics and power dynamics. We don't have the countervailing forces that Galbraith talked about. We have, diminished unions and various other things, but we have more will for restoring some kind of balance. And so we're seeing, in my view, a future in which we will have a shareholder-oriented corporate governance system, absent some really significant federal type of shock to the system, because the system itself has momentum towards keeping it that way. But it is under pressure, and I think not as a decline in corporate governance. That's where I think I differ from Steve. I think this is a good thing, exploring a broader understanding that promotes more social welfare. And the way that I think that's going to be playing out is that CSR has really morphed into a discussion about ESG, environmental social governance, and how to incorporate that into our existing framework. And so I think we'll likely end up with, unless we have some bigger shock to the system, with some kind of incremental change, a weaker or stronger version of ESG-informed, shareholder-oriented governance. is what we're starting to see with more discussion about how to take things like diversity and turn it into some kind of equality metrics that can be taken into consideration, ESG disclosures and ratings, and various other mechanisms that are fitting it into an existing system and shifting it at the same time. So I'll stop there. Thanks so much.
Great, thanks, Elizabeth. Okay, so there's at least one question, so we'll get to that in about 30 seconds. Let me just react a little bit to what Elizabeth said and connect that with what Steve had said. So I agree with what Elizabeth said, that this moment seems different. We've been down this road before in some ways. During the 1980s, the idea of socially responsible investing starts probably with churches who wanted to get out of sin businesses and various things like that. And then you saw during the 80s, as a pushback to the takeover craze of the 80s, a bunch of states passed stakeholder constituency statutes, which people like me who teach corporate law, we sort of laugh at those and say, well, the board may think about the whales and employees and all these things. And I think it was a pretty transparent effort to rebut takeover threats. It was just a way that boards could insulate themselves. So very much in that school. And of course, those went really nowhere, in part because there wasn't a cultural moment that I think Elizabeth is describing. Things just seem different now. Like, that was like a pathetic attempt in the 80s. The mood seems different. If you just watch TV, and I'm like Elizabeth, I try not to watch any TV or news, just hiding my head in the sand and hoping things will get better. But if you watch this, the kids these days seem different, and the movement does seem different. I think the real challenge, if that's right, is trying to translate that into a world in which those ideas in our culture can be incorporated into the corporate system without having the knock-on negative effects that Steve talked about. So Elizabeth's just saying, I think the first one of Steve's 3 points is the truth. This is a real phenomenon, and it could be a good thing, mobilizing corporations, just vehicles for collective action to solve problems that government could be solving. Every problem she described is a government problem. Wage inequality and all these things, but government's not doing it. Climate change. So people are like, oh, here's this other mechanism of collective action, corporations. Let's have them do it. Let's have them work on it. Okay, maybe. How do you avoid the problem Steve talked about, I think he used the word camouflage. That's a really good way to think of it, and a problem. It might help solve some things, but it opens up this wedge of agency costs that could make governance really bad. So if it's a real phenomenon, how do we do that? Okay, that's, I think, what the question I have in my mind. But let's go to some questions from the audience. Krista, what's your question?
Great. Can you guys hear me okay?
We can.
All right, great. So I'm Krista Laser. I'm from Cleveland Marshall College of Law, a new professor there. You mentioned that corporate social activism might be designed in part to protect against risk of regulation of corporate social behavior. Is there any evidence or research showing whether regulators are in fact less likely to go after corporations or industries that engage in more social activism? Technology companies, for example, that's one of the industries where we see a lot of activism, but regulators are still going after them quite a lot.
I guess that question is probably directed to me. In terms of empirical evidence, no. In terms of just plausibly thinking about how business works, it seems to me that there's a plausible story to be told that what we're seeing is a phenomenon known as greenwashing, in which companies use their commitments, quote unquote, to ESG issues, for example, to placate, to assuage the concerns of various constituencies. And that includes, but is not limited to, potentially impacting on regulators. But I think the targets of greenwashing are not just regulators, but they're also customers and employees. and probably in reverse order, right? Probably the first issue is millennials and Gen Z folks who work for you. And then because we've seen, right, over the last couple of years, employee rebellions that when I was 25 or 30 would have been unheard of. And then customers, the Colin Kaepernick type thing. And then regulators in third place, perhaps. But I do think we see examples of that. We see, for example, companies like Walmart and some other sporting goods companies that have moved in the direction of, for example, limiting firearms sales, limiting sales of high capacity magazines and so forth, in ways that it seems to me are at least partially intended to tell regulators, look, you don't need to regulate our gun sales because we're moving in responsible directions.
Elizabeth, go ahead.
Yeah, there is some research on this, and there's a number of scholars at Oxford that have papers on corporate reputation that examine different aspects of this, both about governmental response, but also consumer and other stakeholder response. And some of that work is discussed in a book chapter that I think I have on SSRN about CSR, ESG, and compliance. I think I have the sites in there. And I think Hilary Sale, in her article in the Southern California Law Review on social license, also discusses some of that research. And Frank Partnoy and Adam Badawi at Berkeley have a forthcoming paper on ESG and litigation that examines the connection between basically corporate reputation that is created through ESG efforts, or talk about ESG efforts, like Steve is pointing out, it could be greenwashing, and the impact that may have on litigation exposure and risk. So I think there's a number of different connections that you could draw about efforts to create corporate reputation through either real action or greenwashing that Steve talks about, and the effects of that in terms of consumer response, other stakeholder response, litigation response, and governmental responses. So those are some of the scholarly works that I know and research that's happening on those topics.
There's a book I just read in draft form. It's a pharmaceutical executive whose name is Vivek Ramaswamy, I think, called Wokenomics. And he offers a bunch of anecdotes. It's just anecdata, but he offers his perspective from the corner office that a lot of this is what Steve described. In part, there's promises and then there's promises. The promises that are made in an S1 or a proxy statement, those are promises. And then there's the promises like, well, we're the good guys, so you should back away. Those are different kinds of promises. They're not as enforceable. One idea could be, this is off the top of my head, so it'll be about as worth as much as most of my other ideas. Make companies disclose in their securities filings the purpose and commitments that they're making on these dimensions, and make them legally actionable in that regard, to try to get at some of the greenwashing. Because one of the problems now is there's so many indices for ESG and things, and they just don't have, as Steve pointed out, what's the trade-off between E, S, and G? Sometimes they run in opposite directions. So I think the accountability is much less clear than you made X dollars this quarter. Okay, let's go to another question. David Shizer.
Can you guys hear me okay? Great. Thank you so much for this conversation. It's fascinating. So I guess I have a comment. Maybe I have two comments. You could consider them sort of in the form of a question of, do you agree or disagree? I'm a skeptic like Steve, and just Steve, perhaps friendly amendments. I want to take your camouflage theory, which I very much endorse, and just see whether you agree that it's sort of a three-part issue. So the first is, even if boards and managers are well-intentioned, I don't think they necessarily have the expertise to do a good job in pursuing goals other than making money. So that's part one. Part two is even if they have some expertise, you said this, there's no clear metric for them to trade off profitability on one hand with, say, the social value of preserving a community of workers as opposed to going somewhere else. And then third, and I think you're absolutely right, even if they're not acting in good faith, the opportunities to advance their own interests insincerely through camouflage are legion. So to me, this strikes me as sort of a well-intentioned idea that is potentially going to be extremely counterproductive. With one caveat, like if this is just about what consumers want, then it's fine, right? If a restaurant can make more money by offering locally sourced produce because that's what people like for, say, environmental reasons, that's great. Then everybody's happy. But if we're actually looking to them to do the work that governments and nonprofits are supposed to do, it's a problem. So I wonder, Elizabeth, Steve, whether you agree. And then that brings me to a sort of a bigger point, which is kind of why I think it's especially appropriate that the Federalist Society is talking about this. I see a parallel between ideas that were taking hold in the 60s and 70s, which really prompted the society to be launched, and they have to do with division of labor. You might think that X is a good policy, but do we really think that courts are the right place for this policy to be advanced? Is it legitimate? Is it going to be done well? We might think that Y is a good idea, but why is it federal? Because maybe it isn't going to be an equally good idea all over the country, and maybe we really ought to remember that that's what states are for. And in the same way, I think there's all kinds of reasons to think we need to pay more attention to the issues that people are pushing through corporate social responsibility. But why through corporations? We have nonprofits, we have government. Let's make them work. So I wonder what you guys think.
So I'm going to take the panelist privilege to offer a perspective on this first, then I'll turn to my friends. So thank you, Dean Shizer. So I have an answer to that last question. And it happened to be in the law review from your former institution. So my colleague Anoop Milani and I wrote a paper in Columbia, I don't know, a long time ago. And our take was, and you'll be happy it has a tax angle. Our take was that there is a market for altruism. People want to help other people. And there are different ways of helping other people. You want to help an Ethiopian farmer because you feel bad for them. You want them to have a better life. You can pay taxes and the government can make a transfer to the Ethiopian government. And that transfer then can go from the Ethiopian government down through various departments to this farmer. You could donate to a charity, and that charity some NGO could go on the ground and help Ethiopian farmers with cash distributions or water filtration systems or irrigation or whatever it is. Or you could buy fair trade coffee, which is just a bundle of regular coffee and a donation effectively to this Ethiopian farmer because they're overpaying them for this coffee. So in that way, that's just a simple example. It may be that it's much more efficient for Starbucks to deliver money from me here in Hyde Park to this Ethiopian farmer for a variety of reasons than it is to go through government or go through NGOs. So in our formulation of the market for altruism, which they're all just competing, there may be efficiency reasons. We talk about the tax implications because those things are taxed differently, whether you work for a company or have shares and so forth. So I think that's a possibility, at least, that corporations, building off what Elizabeth said, they're just mechanisms of collective action, just like government or just like an NGO, and they could be put to these purposes. The real trick is figuring out how you can do that. And of course, they're in the markets where they're competing with each other. They do a really crappy job at it, satisfying the demands of their employees, their customers, and their shareholders. They go out of business. So the boards will have to wrestle with trying to figure that tough problem out. The question is, how can you do this while still maintaining high governance standards and accountability? Okay, that's my take. Elizabeth, you want to take the first shot at it?
Yeah. So, while I really love talking with and reading the work of Todd and Steve, I don't tend to agree with them on certain things, nor with some of the ideas that might have spurred the Federalist Society. But that's in part why I like talking with them so much, because I feel like we all can be so respectful and thoughtful about these conversations. And I think, perhaps differently than Todd on this, that I think that conversation about the old way of talking about it, where we worry that management will just lack accountability if we give any inch to them to consider other things other than some imagined version of them being able to clearly maximize stock price, I think it's just a false kind of neutral characteristic of what's really going on. I don't think you can get away from the fact that corporations act in society, in social and political and cultural systems. And I think that they make decisions that aren't so clear about shareholder maximizing, so they can also make decisions that aren't so clear about how to take into consideration the way that they make profit. So I think it's also been a bit of a false conversation about how it's all allocational at the end. We just distribute it afterwards, and that could be the conversation, but we don't put into corporate governance the idea that we consider those issues in the way that companies make money. I think that's a false neutral characterization, because the decisions about how you make money are embedded in these systems. And I think they should take better account of it. And I think that a lot of researchers and scholars and people in industry are right now working on ways to better take account of it. I think it's always been there, though. I just think there's more will right now to start taking account of that in a way that might work better. And I think that when there's more transparency so that consumers can react and employees can react, we may see just more and more of this, because that was the reality that always existed. And it was an oversimplification to think that this was just some way of maximizing efficiency. Corporate governance was always embedded in these systems. And now there's just more will to take account of them and do a better job of putting that on the people that actually have decision-making power in corporations.
Steve?
Thanks. I want to start off by saying, I think for us as lawyers, this is going to be a growth industry in the future. And in particular, I'm thinking about the wave of lawsuits that we've seen starting in Silicon Valley, but moving out from there, claiming both federal proxy violations and Caremark violations by companies that have allegedly fallen short of their stated diversity goals. Kevin LaCroix at the D&O Diary blog, which if you don't follow his work and you in corporate governance, you really need to, has done an excellent job of keeping track of this litigation. And it started out as what looked like a somewhat quixotic move by one particular West Coast plaintiff's law firm. But as LaCroix has tracked this, it's become a number of plaintiffs' firms now are in this area. There's a lot of litigation coming down the pipeline in this area. And I think what we will see in answer to David's question is precisely what we've seen in other situations where boards faced litigation risk, which is that they'll fall back on Delaware Section 141E, and just as they did with executive compensation and so on, we will see the emergence of a consulting industry, basically. And in fact, we already see that. I was just looking at the website of a company called Anthesis, ANTHESIS group.com, which explicitly markets itself as an ESG consultant to corporations. And what's interesting about their website is that, I'm just going back to it here, they talk about, we have long helped corporate businesses to respond to the sustainability agenda through ESG management and reporting strategies. So what they're talking about here is on the one hand, consulting with you about how to have good ESG management, and on the other hand, how to market the fact that you have good ESG management. And I think, that's precisely what people like Graf Crystal provided in the executive compensation arena will be that sort of, well, we complied with our Caremark duties because we had Anthesis come in and do, they have a example here of a case study of a consumer goods manufacturing company where they assessed the ESG risks impacting the value chain of this company, identifying areas the client needed to act on, which is going towards cases like March and and some of these other recent Caremark cases that have imposed liability where you had failures of risk management, and so I think that's really what we're going to see happening, and indeed are already seeing happening.
Did you have a response to that, Elizabeth?
I just wanted to add that I have also been watching that, and that's part of why Dorothy and I titled the paper "The Corporate Governance Machine," because what we observe in one part of the paper is how corporate social responsibility has evolved into this discussion of ESG, and it is still through the shareholder frame in which that is now being discussed. So something that had not been tied to shareholders when it originally, corporate social responsibility was not about serving shareholders in the mid-20th century, that discussion. But now, by 2020s, it's now morphed into this frame of through the ESG lens, which is for risk-adjusted long-term value, ultimately for shareholders. And there's a whole industry of people that want to make money on this by creating ESG ratings, and then like Professor Bainbridge was saying, giving consulting, et cetera. And so that's kind of the whole machinery that's grown up around corporate governance. And so part of what we see is I think, a real shift in the will to do things through corporate governance. But we're also going to see a lot of people that make money, frankly, from these efforts. And a real difficulty, I think, for courts and other policymakers to figure out what obligations to actually put on corporate directors in how to manage these expectations, and then how we can evaluate them as citizens, as employees, as investors, et cetera.
Yeah, and I mean, I agree. I think that, Steve points at a cost, and he's written a lot about, how Sarbanes-Oxley was the Accountants and Lawyers Full Employment Act of, 2002, whatever. He's making the same point here. It's just worth remembering that shareholders and customers and workers, depending on the elasticities of the demands in those markets, are ultimately paying for the antithesis group to do their work and all the other things that go into complying with ESG. So that's the cost. And then maybe there's a benefit. Maybe there's a benefit to the bottom line. Maybe there's a social benefit, but we have to be cognizant of those costs. I just want to react to one thing Elizabeth said at the beginning. She said something nice about the Federalist Society, and I want to thank her for that. Our name gets dragged through the mud on Capitol Hill all the time. And I think the thing that I love about it is that we can have these mature and professional dialogues. So I thank her for recognizing that. And actually, in point of fact, I think she and I agree on this more than we might be expected to agree, in part just because I think there is a moment, and I think there is a potential real benefit, as I responded to David's question. But I do think it has these costs, and we can't just push them under the rug. We need to recognize that those are potential costs or downsides and try to figure out a way that we can have the good without having so much of the bad. Okay, let's see. Next question is my former student and current colleague, Emily.
Hey, everybody, can you hear me?
We can.
Awesome. Thank you guys so much for making the time to do this today. As Todd said, I'm now his colleague at University of Chicago. I want to ask about California's law, the AB 979, mandating board composition. This is the one referring to, you have to have a certain number of underrepresented minorities, which of course then builds on the existing law that you had to have a certain number of women. And I'm wondering whether this indicates that actually, in some ways, when it comes to ESG, we care more about who's making the decisions than actually the decisions that they are making. And, to use Steve's example of Nike, right? Biting at the bit to get that deal with Colin Kaepernick, and to Todd's point about, hey, we're, want to make this sort of loose promise, like you can trust us, we're the good guys. Do corporations that then pay attention to their board composition, even if not required to under California law in this way, buy themselves a little more cover on ESG because we think that a board with a different composition might be sort of baking that kind of an analysis into the decisions they're making without it being mandated on that like sort of outcome end of things? Or, is there something else there? I mean, I think this sort of plays into these questions. And I sort of heard Elizabeth say there's a little bit of ebb and flow on these things naturally over time, and then there tends to be reactions and then we pull back, and I think that makes sense. But of course California is California, but is that sort of a genie that goes back in the bottle at any point?
Yeah, and I think it's interesting because if I was the CEO of a company today, I would agree with what Elizabeth said, that these times are different in some way. I haven't figured out exactly how, but these are different times. I need different board members. I need board members who are attuned to this new thing that can help us make these decisions. And as Steve said, the boardroom becomes a much more complicated place, and the problems become much more complicated if you're taking all these things into consideration, as opposed to just how can we maximize the bottom line. It's much more PR. It's much more tied in with what the zeitgeist is. So I might want very different board members. And then you've got California that says, well, you need women and minorities and LGBT people and whatever other identity groups there are. That's not really about necessarily improving on the dimension that I was talking about. It's just about representation and equality and access and, glass ceilings and stuff. So those things seem like they're not very related, but maybe they're related. Okay, Steve, let's go to you first for some thoughts on Emily's question.
Well, I think the legislation, I mean, I live out here in California, and I guess I've gotten used to the idea that we lead the nation in moving in new and sometimes controversial areas. I think what realistically is going to happen in this space is that, number one, somebody eventually is going to challenge the California legislation, and that the problem with the California legislation is that it's basically taking quasi-foreign corporation regulation to an extreme. I don't think that you can constitutionally use principal executive office, whatever the hell that means, as your jurisdictional link. And that at some point, somebody's going to say to California, you can regulate companies that are incorporated in California, but that's it. And that's going to move it, as with a lot of this stuff, into the federal area. I think I've written a lot over the years about federalization of corporate governance. And as long as Delaware remains supreme, as long as people give constitutional weight to the internal affairs doctrine, and as long as Delaware remains reluctant to move in this area, that's going to be pressure to do it at the federal level. Roberto Romano wrote a great article about Sarbanes-Oxley called, Quack Corporate Governance. And I riffed on that with respect to Dodd-Frank and Quack Corporate Governance Round 2. And I expect sometime around 2023 to be writing an article about Quack Corporate Governance Round 3. Because I think this is going to, I think the folks that are in favor of doing the sorts of things that the California and legislation does are going to recognize that doing it at the state level is not going to work, and then they will move into the federal space.
Yeah,
and
I mean,
probably sooner than 2023.
Yeah, if Texas passes a statute that says corporations that do business in Texas cannot take into consideration people's race, gender, whatever it is, in determining whether they're a board member. You're a Delaware corporation with its headquarters in California. You literally cannot comply with with all three of the statutes. So it's just an impossibility. And I agree with Steve that will mean federalization, the Liz Warren moves are more likely. Elizabeth, what do you think?
Yeah, I guess I think somewhat differently. First of all, I'd like to be very clear that I think that it is hugely important that corporations, especially large, societally important corporations, become more diverse and inclusive at the top levels, board, C-suite, and more. And I think that the California statute is just a particular kind of reflection of societal expectations at this point. And I think it is a positive development on the whole, but there is more conversation about this, and not only more conversation, but real action. And so I think many corporations have already been making efforts to increase the diversity of board composition, but it hasn't been very quick in past times before statutes like California's. And what we're starting to see is more movement on this front. And I think there's a funny thing going on with these statutes that my former professor, Joe Grunfest, has recognized, which was at first he wrote a piece about the potential unconstitutionality of California's statute on gender diversity. But in later remarks, he's made very clear that he actually thinks, it may be unconstitutional. I don't have a view on that because I haven't studied the constitutionality issue, but it has been effective in actually having some real world change, because in the time since California made a statement through its statute on the issue, many corporations have been coming into compliance with it, and investors have started expecting it and asking for it. And I think there'll be a similar thing with other types of diversity, that it takes years to litigate these things. And the constitutionality issue in some ways isn't really what the point of it all is. It's more about actually seeing some social change and having large corporations engage in real diversity and inclusiveness efforts. And so I think, like, who knows what'll happen with the constitutionality of a statute like that. But the bigger picture that I see is that corporations are actually making their boards more diverse in a faster way than they had in sometimes past. And investors are asking for it. So it's not just a legal issue, it's a market issue at this point about social expectations. And I think it's a good thing that the market is coming into more alignment with general society and expecting more diversity and inclusiveness and equity in corporations.
That's a fascinating take. It's let's pass a statute that we believe is illegal or impossible with the goal of motivating the market and people to do something we think is socially positive. And then, 5 years from now, the courts will fight it out. And if we lose, we've probably already won. It's a bold way.
May be what's happening.
Yeah, totally. Okay, we've got about 32 minutes left. There's four people in the queue. So we're going to try to I want to get to everybody, and there may be additional questions. So quickly, let's go through to Eric. What is your question?
Thank you. Also former student of yours, now teaching at the business school at CU Boulder. And
now that I see your picture, I recognize you, Eric. Sorry about that.
No worries. And so my question surrounds, if we posit that the sort of market optimistic vision of achieving more sustainable outcomes with our corporate decision-making, that's, consumers demand it, so the corporations will provide it. If we posit that that's unlikely to be sufficient to satisfy the increasing demand for movement towards those goals, such that we're likely to see increasing public interventions like the one we just discussed in California, I'm kind of curious about the panelists' thoughts about the trade-offs between different forms that these interventions can take. And especially, do we want increasingly direct public governance of private companies? We certainly saw that in the 19th century when corporations were creatures of state legislatures directly, but that I don't think was seen as uniformly positive. So that raises the specter of cronyism. but the courts suffer from all the kinds of delays as well that we just heard about. So I'm just curious about the panelists' thoughts about their preferred forms of public interventions for this potential tidal change in corporate governance, as well as the forms that they predict will actually emerge. Thank you.
Great. That's a great question, Eric. Thank you. And let's go to Elizabeth first. One of the things to highlight in Liz Warren's proposal was things like employees get to elect 40% of the board of directors, limitations on executive comp, mandatory 5-year vesting for shares for CEOs, limiting buybacks. There was all kinds of things in there. And I think that's of a spirit of Eric's question is like, once you've cracked open this door in a serious way, you do have this question of, well, how much is too much state intervention in the internal machinery of the corporate governance machine?
Yeah. So I think that it's going to be, and it probably should be, a mix of things. And this kind of ties to an earlier question about the relationship between action by corporations versus action by government. And I think that it's been oversimplified to suggest that it's one or the other, because they often are actually very dynamic as a process of what's happening. And so I think that we might see different types of regulation, and there's a lot of different ideas about policy proposals. Leo Strine had a paper last year that had such a long title that I'm sorry that I can't think of the full title off the top of my head, but it was about sustainable capitalism. And it has about 20 or more different proposals about different things that you could do about human capital management and employee and stakeholder voice and governance, et cetera. So there's a lot of different ideas that are flowing around, and some of them I think are quite good about different things that could be done on the regulatory front. Though I'm not endorsing all different proposals, but I think there's a lot of different ideas about things that could be done. And then on the corporate governance side, I think that we will likely see this slow movement to incorporate more stakeholder interests and to temper the externalities of corporations through mechanisms of corporate governance. And it'll still be done, I think, ultimately tied to some shareholder lens of long-term value. And so a lot of what rides on that is how well advocates can propose ideas that fit into this framework that we already have and understand about promoting long-term shareholder value and corporate value, but incorporating ideas like diversity and climate and other social issues, et cetera, through that mechanism already. I personally don't know that we need to upend all of our ideas about boards of directors, et cetera, to take a better accounting of the impact of corporations on society. We already have a system that's working pretty well in some respects. And so I think it's tempering that is what's happening through the corporate governance mechanism.
Yeah, just to harken back to something you said at the beginning in the student note you wrote or the paper that you wrote about there's a diversity of shareholders. Of course, there's something, as Steve said, there's a diversity of customers as well. And once you start moving in this direction, unless the globe moves in that direction, then now, if there's a huge chunk of people that just want the cheapest possible product produced in the best possible time, they could give a rip about the climate or the whales or whatever it is, you're going to end up with American companies who may be systematically disadvantaged in these global markets, at least with respect to some portion of their consumer base. The same for shareholders. There's a bunch of shareholders who just climb out of the coal mine every day, who want their retirement fund to be as big as possible. And they don't care about, in fact, the climate stuff is antithetical to them. So, the schism, and as Dean Shizer pointed out, if you're just trying to satisfy a group of constituents, go ahead. If you fail in the market, you go out of business. And we could have, red state companies and blue state companies and funds that are producing the biggest possible investment return and funds that are focused on doing good in the world too. When you get federal government involved, well, then everybody's got to go along for the ride. They're ideas that are so good, they're mandatory. And that, I think, is troubling. Steve.
Very briefly, comply or explain. I've become a big fan of that mode of regulation in the securities area, and it doesn't seem to me that if we're going to have regulation in this area, it's the kind of regulation that I think would work. better than most in terms of, if we're really convinced that there's a market for this, then requiring companies to either adopt a diversity policy or explain why they didn't, adopt a diverse board or explain why they didn't. I think Elizabeth was quite right about the impact that the California statute is having, in that, you know, the litigation is coming from folks that are, you know, like conservative think tanks. It's not coming from companies. And so I think that's basically right. And you know, a comply or explain approach to the regulatory problem seems to me to be one that would leverage whatever demand there is for this sort of thing with, you know, still preserving options.
Yeah, that's great. And just to, before we turn to Lee, the comply or explain principle comes from Sir Adrian Cadbury, who wrote this thing called the Cadbury Report in 1992. After a kind of stock market collapse and some corporate scandals in the UK, they were looking for answers. And what I loved about Sir Adrian Cadbury is his humbleness. Too many academics think they have the right answers and want to impose those on people. And Cadbury's like, I don't know. Here's some ideas. Maybe they're good, maybe they're bad. If you like them, adopt them. If you don't, tell me why I'm wrong, effectively. That kind of very humble form of regulation is what he proposed, became the corporate governance code for the City of London. I think we need more of that. I heartily endorse Professor Bainbridge. Okay, Lee Otis.
Hi. I have a couple worries about this. One of them is that you really end up privileging elite causes with this kind of new regime, and the other is that you're contributing to polarization, societal polarization in an unhealthy way, partly related to the first point, because it's possible that elites are kind of more opinionated and more sure they're right about these things, to tie into Todd's last observation. For example, you know, on that point, you know, it's easy to think that there's societal consensus on these diversity requirements, but actually in California, you know, California rather overwhelmingly rejected that as a value, at least in, you know, a number of contexts. And so, but you know, I worry also just about the negative externality, I guess, of contributing to polarization, which I feel that is, you know, basically that it leads to politicizing, you know, the sort of politicizing how corporations do things, you know, is part and parcel of politicizing everything, and soon we're sorting ourselves out into, you know, red and blue everything.
Steve, you want to take a crack at that?
We're gonna, you know, I mean, there are so many drivers on polarization. I don't think this matters all that much. And the interesting thing to me here is that historically, right of center populism has been strongly anti-corporate, particularly anti-big corporate. Elizabeth was kind enough to refer to an article that I wrote on corporate purpose in a populist era that was in the Nebraska Law Review a few years ago now. And one of the things I did was I went back and I looked at populist movements in the post-Civil War period, and you look at right of center, and I focused on right of center populist movements, and they historically were agrarian, particularly, well, obviously the Southern agrarians being the best example. And thinking about how a right of center populist movement with Tea Party and Trump folks and so on might play out. And I think there's a strong reason to suspect that the historical anti-corporate sentiments that we've seen in the agrarians and the Southern agrarians and so on would be picked up. I see a lot of parallels, if you will, between the folks who are supporting Trump and the folks that were supporting the Southern agrarians, in a whole host of issues. And so, I think that there is a strong sense here that there's going to be a reaction, not against corporate social responsibility, but a reaction against the corporate entity, the corporate form, amongst right-wing populists over the next, however many decades.
Elizabeth?
Yeah, and probably from the left as well. And so I'll be brief and say simply that I think there's a lot of room for us to still put more expectations on corporations, especially those with a large social footprint, to be more socially responsible without being in danger of increasing the politicization of the moment. We're already there. It's already pretty toxic politically, I think, in many ways in society right now. So I don't think expecting more from corporations to act socially responsible is going to worsen that. If anything, I think it has the potential to improve social discourse. And I think we should simply be careful not to confuse those expectations of corporations acting responsibly with somehow thinking that corporations are now political expressive associations and granting them rights in that way. I don't think that turns them into that. I think we can have social responsibility of corporations without politicizing in an overly sense of what we're putting on corporations.
Yes,
I hear you. I'm with Lee. I live in Hyde Park. I go to walk by a lot of stores that have signs that say Black-owned business. And I think that's a very frightening sign. The wealth that has been created since 1820 has been driven largely by the fact that I can walk into a store, exchange goods or services with someone, and it's irrelevant who they are, what race they are, what gender they are, what they do in their bedroom. That's all completely irrelevant. It's a mutually beneficial transaction. We call it a day. The increasing the velocity of those transactions, the frequency, is what has made us have the wealth we are. And if now, well, I won't do business with you because you're Black, or I will do business with you because you're Black, I think those are exactly the same thing. And I think there's a one-sidedness to this kind of, social good thing that's highly disputed. So I'm with Lee. I think that is a real risk that we are going to put sand in the gears of voluntary exchange. We need more voluntary exchange. Okay, John McGinnis.
I don't think those are the same thing.
Maybe not. John?
Hello, sorry. Yeah, so my question is, what are the constraints of the market on this kind of corporate responsibility? Obviously, at the state level, you can go to other states. Even if it's at the federal level, we have worldwide investment, more of the other kind of investment forms other than companies. Isn't that some constraint? And let me be specific about this. As an investor, I'm worried about this, so I'm looking for other places to put my money if this comes. And it's not only because I'd like to earn a higher rate of return than I fear that these will cause. Like some of you, the rest of you, I'm not sympathetic to, for instance, at least many forms of diversity inclusion, which in the academic world I've seen as a thin veneer for discrimination. So in some sense, my views on getting a high rate of return and fulfilling my own interests in the public good would actually be aligned by going elsewhere. So I wonder, is that a substantial constraint on this going forward?
Eve, Elizabeth, anybody have a thought on that? I mean, I think it's interesting that Gene Scalia, Labor Secretary, tries to push through a rule that basically forbids investment funds from taking these things into consideration, as opposed to saying, let the market decide. There could be investment funds that say, we're greedy capitalists, the Gordon Gekko investment fund, and we are going to just maximize the returns and try to appeal to people like you, John. And then you could imagine there's the do-gooder fund and says, we're going to only invest in these companies that commit themselves to progressive causes, and you obviously wouldn't be putting your money there. I think where Scalia was coming from is that there's a bunch of workers in labor unions that don't have free choices. They're not rich law professors. They get pushed into these progressive funds that are driven by choices by their labor union representatives. And those are ones that are systematically going to be aligned with the political left, and those people are going to be disadvantaged. That's where it's coming from. But you can imagine, just let the free market decide where people put their money. But I don't know if Elizabeth or Steve have any thoughts on this.
Well,
I think, yeah.
Oh, go ahead, Elizabeth.
I simply think that there's a lot of research, and I think there will be a lot more in the next 10 years that will likely start to make a very strong case that treating workers better and having more equality and various other values that were noted in the question actually promote long-term value and sustainability. I think the market is already starting to recognize that. So I don't think that there's the trade-off that might be imagined actually coming to fruition. I think the market has done very well. I don't think that's our biggest concern right now, personally. And I think companies can do well or continue doing well by increasing efforts to take some of these considerations like climate and workers and diversity and other things into account.
I'll just add that I think I'm with Todd. I think, if you let the markets decide, that's probably in the long run the best. I have been looking for a while now at rejiggering my investment portfolio to better align with my beliefs as a Catholic. And I've been looking, for example, at there's an outfit called Global X that has exchange traded funds, and they have an S&P 500 Catholic Values ETF that takes the S&P 500 and applies to it an investment screen that uses Catholic social teaching as its guidelines for screening. They also have a global equities fund that does the same thing. And I'm inclined to put my money there. It's a 4-star Morningstar rated fund. And it's, I think that's the kind of thing the market's good at is saying, okay, there's a lot of diversity in what investors are interested in, and specifying, okay, we don't all have to be, the Liz Warren mutual fund. There's room to be the John Paul II mutual fund. And I think that's why I would prefer to leave a lot of this up to markets.
There's a trick though. So yes, and for investment funds, they're easy to produce. They're trying to attract funds, and there can be pure segregation. You can have the Catholic Values Mutual Fund and the Liz Warren Mutual Fund. For product companies, that's a little bit harder because we don't need 2 Amazons. We don't need it's strange to think people are going to be competing on telephone service based on that kind of thing. Chick-fil-A got into this problem. And I think that's the thing that Lee Otis was talking about. And then when it comes to the boardroom, of course, the board is the place where these issues are hashed out on the kinds of things, eleemosynary activities the board's going to engage in. Once that veneer is lifted, Berkshire Hathaway tried for 1 year to allow their shareholders to pro rata allocate charitable contributions that the firm was going to make. It only lasted a year because now I saw that some people were giving to NARAL and I was giving to some pro-life thing, and the whole thing just sort of collapsed. It was fine when the board was doing it and doing a kind of trying to balance. Pulling back the veneer and everybody having their own cause, I think risks blowing up a bunch of stuff. Okay, let's see. Andrew Schwartz. Hello, Andrew.
Hello, thank you. Good to see you all. Great discussion. Thank you. As Elizabeth said, I mean, and others have mentioned, the goal here is to advance social welfare, and I certainly agree. But I would add that the issue is social welfare over the long term, not this quarter or year, as you mentioned a moment ago, Elizabeth, in part because corporation is endowed with perpetual life. And as people have said, decisions to make to maximize long-term shareholder wealth regularly benefit stakeholders at the same time. Everybody wins. Social welfare increases. For example, company might increase its wages to attract talented employees who increase profits over and above the increased labor costs. Or you could sell environmentally sound products that consumers love and are willing to pay a premium price for. But if this concept of stakeholder governance has any meaning different than that, it's that corporations should be free to make choices that benefit stakeholders at the expense of shareholders. It is inherently zero-sum rather than growth-oriented. So in this way, I see stakeholder governance, which is, I guess, my term for what we're talking about here, it's unsustainable over the long term because it lets companies just shift resources from one group to another rather than generate new wealth and advance social welfare over the long term. So, just as an example or two, I think that many of the dot-com failures that we mentioned earlier, maybe we're just pricing things too low. They were benefiting their consumers too much and they went out of business. They didn't generate a long-term social benefit compared to, say, Amazon, which, has low prices, but is a long-term benefit to the shareholders and to the stakeholders. So that's my comment / Dean Shizer question.
Comments from the panelists?
Yeah, I think in the long run, even the most woke CEOs are not going to let these sort of, woke concerns get in the way of continued shareholder wealth growth. And I'm thinking of, again, I go back to Salesforce.com CEO Mark Benioff. Is there been a more outspoken progressive CEO than him? Last year, a day after they announced record quarterly sales results, Salesforce announced that 1,000 employees were going to lose their jobs during the fourth quarter of 2020. One day after announcing record quarterly sales, 1,000 out of 54,000 employees were going to lose their jobs before Christmas, which to me seemed like a sort of Scrooge thing to do. And so, if I say that not to suggest that I think what he did was admirable, I say that to suggest that if he's willing to do that to maintain shareholder value, I don't think we're at the point where we need to worry about, the shareholders of GM and Ford all of a sudden deciding that they're not going to make large pickup trucks anymore. That they're going to make little econo boxes. You know, they're building F-150s faster than ever these days. And so, you know, I think in terms of, I don't worry a lot about companies deciding that all of a sudden, okay, we're just going to say we're going to take, you know, negative shareholder results so that we feel good about you know, the world. So, you know, it's not something I worry about a lot.
Yeah, it's interesting that Liz Warren's Accountability Act requires mandatory 5-year vesting for CEO stock. If it was the case that she really wanted to solve the Benioff problem, they should ban CEO stock compensation, right? The move to getting CEOs paid like shareholders was to get them to think like shareholders. If you want CEOs to think like stakeholders, surefire way is to not pay them like shareholders. Let's see. We got
well,
5
the biggest mistake
Yeah,
the biggest mistake that ever happened under Bill Clinton's watch, and Lord knows there were a lot of them, but the biggest mistake they ever did was to cap CEO salaries and push everything in to stock options. But that's a story for another day.
Gene Meyer.
Yeah, I'm sorry, I'm not sure. Did I unmute myself?
We can hear you, Gene.
Okay, good, thanks. Yeah, I wanted to go back for a second to this question of elites. And one of the things I guess I just to ask about is, it seems hard to believe that the decisions about what is corporately responsible, what is good corporate governance in that way, is going to be made by anybody other than elites. And it is clear that, it seems to me clear, that a reaction to elites was almost 100% behind Trump's success and electorally. And I thought it was, for me, I thought it was one of the more reasonable parts of support of Trump was, look, these elites are running things for their benefit, not for ours. It's hard. I guess the question, if we do what you're talking about, doesn't that just compound that problem? And isn't that something that builds up over time, so that it might not be that the entire problem now, but it will be considerably contributing to it over time?
Thanks, Gene. Do you have a quick response to that, Elizabeth?
Not a quick response to it, but I would say see Bainbridge on populism, and I think that this time is no different than others in that regard. And if anything, I think efforts at more diversity and inclusiveness could temper that concern about people with only certain types of credentials or elites filling certain roles.
Okay, we've got 2 minutes. Kate, let's squeeze in one last question.
Can you hear me, guys?
We can hear you, Kate.
Okay, thanks. My issue is that my problem with this discussion is that you guys are making a lot of empirical assertions without actually using empirical evidence for those assertions. For example, the best empirical research says that there is no, Jesus, what's going on? That there is no impact of board composition on company performance in the US. There is no such thing as glass ceiling in the US. There is no impact of most of corporate governance on basically anything. In the US, yes, not, abroad, yes, but not in the US. And so when I keep hearing this panel saying things like, we just need to treat workers better and better things will happen and so forth, there is no empirical evidence for any such thing. So I think, to me, it's very clear that the sole purpose of all these corporate governance reform efforts is social engineering and not actually improvement in economic performance of companies. So when people see us empiricists saying that there is no evidence that putting more women on company board changes anything in company performance, these people say, well, that means it doesn't actually hurt companies, so let's do it for social engineering purposes. And here is a completely different discussion. Maybe if it's harmless, then it's okay. But what I don't want to happen is for people to cook up empirical propositions that are simply false. Thanks.
Yeah, so we're pretty much out of time. So I just respond and say, I agree with what Cade said, that there is not a huge amount of evidence. David Larker has a great book where he lays this all out. And, you know, I think we're in the realm of describing a phenomenon that's happening and what people are demanding and how corporations could respond to that. And if they, you know, we talked about a lot of things that were other than just putting women on boards. But I think I'm with Elizabeth in saying that if companies just said, look, there's no empirical evidence that there's anything going on here, let's just keep driving ahead and doing what we're doing, I think they're going to be missing a moment and a real change among their employees and their customers and their shareholders. I think the real trick, and I look forward to reading the work of Elizabeth and Steve and others as we go forward, is can we possibly design a governance system that allows those things, what Anoop and I have called the market for altruism, to be effectuated through corporations without killing the golden goose, which has laid us so many amazing eggs. Like, that's the real trick. How do we take this cultural phenomenon and make it a part of our corporate schema, which has been, you know, undeniably the most successful invention in all of human history? Okay, I have to go teach securities regulation. I'm to remind you all that there is the next panel is the Young Scholars paper presentations, which starts at 3 p.m. Eastern. I want to thank my friends, Elizabeth and Stephen. I've been trapped in my damn house for 9 months, so it's misery, but seeing their faces and getting to talk to them and hearing from you all has been a real delight for me for these 90 minutes. Thank you for joining us. Enjoy the rest of your day. Godspeed, everyone.